Welcome to Oregon Cash Flow Pro. My name is James Barber, and I'm here to help you maximize your cash flow. Today, I'm going to walk you through the steps on how to request a loan from your Guardian life insurance policy. So let's get into it.
Oregon Cash Flow Pro offers free money management advice to help you take control of your finances. And now here's your host, personal finance enthusiast and licensed insurance broker, James Barber.
First thing we're going to do is we're going to go to Guardian's website and we're going to log in. Now from the main page, we can see how much cash value we have in our policy, the outstanding value of any loans, and if we want to check to see how much we can borrow, we're going to click on our policy and we're going over to loan details. And you can see here, we have an outstanding loan and we have the max amount available to borrow. So from here, you can do this from the previous page also, but from here on the right-hand side, you just click Request a Life Policy Loan. And now these are all of the different things you can choose while on your Guardian policy site. But since we chose the loan, this option is already checked, so it's a loan amount. We're going to scroll down and we're going to fill in all of the boxes that are in yellow. If you have more than one owner on the policy, then you'll want to click yes. There's additional signers. In this case, we just have one owner, so we're going to click no. And then it's going to ask, is the policy owner a U.S. citizen, U.S. resident alien, or U.S. entity? And we are going to click yes, because that is the case in this instance. And are you subject, and then it's asking, am I, the policy owner, the contract owner, subject to backup withholding as a result of failure to report all interest and dividends on my tax return? No, I am not. Now we're going to select our resident type, find your address. In the drop-down menu, it will pre-fill the rest of the information. Input your phone number and check if there's an address change. Check this box. Okay, no address change for us, so we're going to continue. And now it's going to ask loan in the amount of how much we would like to borrow. Notice it says here, it says, please read the policy loan and withdrawal education supplement on page 7 when you preview your form to ensure you understand the implications of a policy loan before making a selection below. Now we've done a number of videos on policy loans. Check those out right over here. And we can either put in an amount here, or if we uncheck that, we can check maximum loan amount available. I'm just going to take everything out that's available right now. And we want to, you can either mail a check or send the proceeds electronically to the bank information on file. That's what we are going to do. Will be a direct deposit. And you can see it says direct deposit for clients with current bank draft authorization. Since we have a monthly payment that comes out, Guardian keeps our bank account information on file, and it makes it really easy to just get this electronic funds transfer that way. And it notes if the account is not eligible for direct deposit, or we are unable to verify the bank account has been used to pay policy premiums in the past by the policy owner or an approved account holder, the distribution will be mailed to the owner's address of record. Any account information listed above will only be used to process the disbursement request and will not impact how policy premium and or loan interest is currently being funded. Check the box which acknowledges that we have read the policy loan and withdrawal education supplement on page 7, and we understand the implications, and that we've read all the other sections of the forms. And the information is true to the best of our knowledge. Next, it's going to go into federal income tax withholding, and we do not want to withhold any federal income taxes because we don't have to. You're just taking a policy loan, and this is not a modified endowment contract. If this was a modified endowment contract, or if we anticipated it becoming a modified endowment contract for some reason in the next 2 years, we may want to withhold some federal income taxes. That's not going to be the case, so we do not want to withhold anything. And we're not going to withhold state income taxes as well for the same reasons, and we'll continue. Now we can preview the forms, and we have to click that in order to move on. So now I'm going to verify all the information on the forms. Looks like we've got 9 pages to scroll through and verify. Obviously, not all of these options are going to apply. You can see there's a lot of different choices on what you can do with the value in your policy. So here we're at the loan amount and type. We're on page 3 of 9. We're requesting the maximum loan amount available. If I had checked the other option, that would be right here. It would fill in. And scrolling down, we opted for a direct deposit. And if we wanted a direct deposit and we did not have a current bank account on file, we would have the option to put in our banking information here. The information we put would fill in this section. We're not planning on mailing it, so this part's empty. Next, we got our tax certification, which would only be checked if we were subject to withholding. And then do not withhold state and federal income taxes. Again, they're going to remind you to read the supplement beginning on page 8. Here on page 5, it says, under important information, by requesting a policy loan, you agree to assign the policies listed on this request as sole security for this loan. Terms for interest and repayment of the loan are subject to the provisions of the policy. A loan will affect the cash value and the death benefit of your policy and may have other consequences, including the risk that the policy may lapse. Please refer to your policy for important information. So those are important to understand. Obviously, the loan affects cash value and the death benefit because anything we're going to withdraw is going to reduce the amount of cash value that's available to borrow, because that amount gets collateralized by the insurance company. And then, of course, it also collateralizes that same amount in death benefit, because if we don't pay this loan back, the death benefit will pay it off. Now, this is where it goes over the withholding states and the options for state tax withholding. This is only if you're subject to that withholding. If you're doing an actual withdrawal of funds from the policy, not a loan, or if the policy is a MEC, then even including a loan, then you would follow these guidelines. Since we're just doing a loan and it's not a MEC, we're going to ignore this. We're not going to have any state tax withholding. And then we've got our signature below. So that's where the electronic signature will sign. Here, if there was somebody else on the policy, they would sign, or your spouse if you're in a state that requires that. And here's our policy loan and withdrawal education supplement. So we'll just go through this fairly quickly. It talks about how you can access your life insurance policy cash values, either through a withdrawal or a policy loan. Note that the withdrawal permanently reduces the death benefit. Okay, if you want to take money out of your account, it's no longer going to have the paid up additions that it bought. That's what a withdrawal is. It's, as we can see, a withdrawal is an actual cash distribution from your policy's paid up additions. It basically refunds the paid up additions, gives it to you in cash, and reduces the death benefit accordingly. That money is no longer going to be in your account and compounding. So we don't do withdrawals, we do policy loans. And a policy loan is money that you can borrow from the policy. The loan is secured by your policy's cash value. Note that it says, while the policy loans are not contractually required to be repaid during the insured's life, you may be required to submit a loan repayment if the loan balance exceeds your policy's cash value. Your policy will terminate if you do not repay the portion of the loan that exceeds the cash value. Outstanding loans accrue interest and reduce your policy's death benefit and available cash surrender value. You must pay the policy loan interest, or the interest will be capitalized into the loan, increasing your loan balance. Now, that doesn't mean that you're required to pay the policy loan interest. It's just noting that if you don't, it's going to be capitalized into the loan, and it increases the loan balance, which you'll pay interest on your next anniversary date. While these loans are calculated as simple interest loans, note that the interest that you're paying on them will compound if you do not pay the interest. Okay, also note you may repay your policy loan at any time. Any outstanding loans plus unpaid loan interest remaining upon the insured's death are repaid using the death benefit, which reduces the death benefit that's paid to your beneficiaries. I think that's self-explanatory. Before you request a loan or withdrawal from your policy, we recommend that you review your policy's provisions, obtain and review an illustration showing the effect a loan or withdrawal will have on your policy, seek the advice of your personal tax advisor regarding potential tax consequences. Let me go back to that last one. Obtain and review an illustration showing the effect a loan or withdrawal will have on your policy. Now, we're unable to do an illustration showing that within the first year. So if you're accessing your policy within the first year, just recognize that. We can't do an in-force illustration within that first year. But after that, we can. We can show you what that loan will do and what it would look like if you don't pay it. Now, as with any illustrations, it uses a lot of assumptions, and those assumptions are going to be based on guaranteed values or current dividend rates, which inevitably change. Next one, seek the advice of your personal tax advisor regarding potential tax consequences. So this would be in regards to if your policy is a modified endowment contract, or what we call MEC, or there's a 2-year look-back period. If your policy becomes a MEC, they can go back 2 years and assess tax consequences on any activity in your policy that should have been taxed based on your contract being a MEC. Once you take a loan or withdrawal, monitor and review your policy periodically to reduce the possibility of your policy lapsing. Contact your financial representatives with any questions. Understand that taking a loan or withdrawal from your policy may increase the possibility that your policy will lapse or that a lower death benefit will be paid to your beneficiaries. Further, if your policy lapses with a loan outstanding, you may have to pay tax on the amount you still owe to your policy. There may be several factors that could contribute to the lapsing or termination of a life insurance policy, such as not paying premiums, not paying loan interest, and policy loans equaling or exceeding the maximum amounts as stated in your policy. Now, when it refers to possibly having to pay a tax on the amount that you still owe to your policy, that would happen if you have gains in the policy. So if you've put in $50,000 into your policy, you've withdrawn $75,000, $80,000, $90,000, and your policy lapses, you have whatever the gains are above that $50,000 that you paid in premiums that you will owe taxes on. So that's something to be aware of. Your whole life insurance policy develops guaranteed cash value based on the guaranteed interest rate as stated in your policy. If you own a participating life insurance policy, you may also receive policy dividends. Dividends are not guaranteed and are declared annually by the board of directors. If you take a withdrawal from your policy, this will be done by surrendering paid up additions. The effect of this is to reduce your death benefit and cash value as well as any future declared dividends. In addition, an outstanding loan will affect any dividends credited to your policy. Then it's going to go over tax considerations. A withdrawal can generally be taken from a life insurance policy income tax-free up to your basis in the policy, which is generally equal to the cumulative premiums paid less any previous untaxed distributions. Income tax-free withdrawals reduce your basis, and any withdrawals in excess of your basis are taxable. It is important to note that if a withdrawal reduces your policy's death benefit, a withdrawal taken within the first 15 years of the policy may be considered a taxable event, even if the withdrawal is not in excess of your basis in the policy. Now, what that's referring to is when we design a policy and we opt to max fund these policies, we have to have a certain amount of death benefit in order for it to qualify as life insurance. When there is a substantial change in the policy, typically if the death benefit gets reduced, that can change whether this qualifies as a life insurance contract, meaning it can trigger a MEC. The policy can become a modified endowment contract. If the policy death benefit gets reduced for some reason, you have to make sure that it doesn't affect the rest of the design of the policy so that it automatically becomes a MEC. And if your policy becomes a MEC, it says here, loans and withdrawals are taxable income to the extent that there is gain in the contract. If you're under age 59 and a half, taxable distributions are also subject to a 10% early withdrawal penalty because life insurance contracts offer the same tax-deferred benefits as retirement accounts. So notice the penalties also reflect what you would see in a retirement account. If you take out early withdrawals, meaning before age 59 and a half, in a retirement account, you're also subject to that 10% early withdrawal penalty. Next, it goes over how withdrawals affect the accelerated benefit rider, which is our terminal illness rider, and any long-term care services rider as well. And that's it. That's our policy. So now that we've reviewed it, we're going to close that window. And now we're going to electronically sign and complete the loan request. Okay, we have to agree to use electronic records and signatures and continue. Now you can click the start button or you can just scroll down. We're going to click the start button and it'll take us right to where we need to sign. So if you wanted to read through it, you got to scroll down through it. Now we've already looked through this, so I'm not going over it again. This is everything that we just looked at. So we're just going to click sign. Adopt a signature and sign. And then in the upper right corner, we're going to click finish. And that's it. Now you can view your signed form. You can print it if you want to keep a copy of it. I'm going to click done. And that's it. As you can see, it's quite simple to request a loan. Takes just a little bit of time, and I should expect those funds deposited into my account, typically within 2 days. I hope you found value in today's video. Be sure to join us each Wednesday for our Wealth-Care Wednesday live streams, where you get to ask questions. I will answer them to the best of my ability, and we'll continue along on this financial journey together. Thanks for watching. If you want to see more videos about Guardian or policy loans, check those out right over here. See you next time.
Now go maximize your cash flow.